Steve Sabaji, the IRA specialist for the Austin office here at Quest Trust Company. And I'm sorry if we are getting a little bit of a late start, but we are ready to go now, and we have a great presentation for you today. We are featuring Troy Eckert, who is one of the premier guys in the oil and mineral field. So I think we're going to get a lot of good information from Troy today. However, I'd like to just get started with the presentation. We just want to do a brief presentation before we get into the content of this afternoon. First, just going to give you a little background in terms of Quest Trust Company and who we are. First of all, we are the largest self-directed IRA custodian in the state of Texas, and we are one of the largest in the country. We do have at this time in excess of 20,000 active investors in our client base nationwide. We currently have under administration in total assets in excess of $2 billion, $400 million of which is in undirected cash, meaning we have clients who are looking to make deals. So if there are opportunities that are out there that you may have, or for lending, borrowing, anything of that nature, our clients are a great resource. On the other hand, if you are one of those clients, then content like this today is going to be a great place to begin to learn more about the opportunities that present themselves. Now, just to be clear, with respect to the information that's going to be presented here today, this is purely for educational purposes. Always remember to contact your tax, legal, or investment advisor before entering into any kind of transaction, and always be sure that you are doing your due diligence first. Now, I'm just going to talk a little bit about self-directed IRAs and what they are. Basically, a self-directed IRA is no different than an IRA that you would find anywhere else. The only difference, and the reason we make the distinction as to self-directed, is because with a self-directed IRA, you truly do get to pick the asset that you're putting your money into, as opposed to going to a mutual fund company where you're turning your money over to a manager. The manager then decides where the money is invested. Here, you really get to pick. So you are getting diversification beyond what the market itself offers. And you can get it in an asset that really doesn't correlate to the stock market as a whole. Of course, IRAs, we all know, come with certain tax advantages, perhaps deductible when the funds go in, tax deferred always while they're in the account, and even opportunities for money to come out completely tax-free when you retire. And the other nice thing is with the self-directed IRA, almost going back to our first point of the diversification, because you select the asset, you truly get to invest in that which you know best. Now, I would just take it one step further. I would also say that there's an element of what I like to think of as social investing that goes along with a self-directed IRA. And here's what I mean by that. Think if you are the person who's out there buying that eyesore of a house that's in your neighborhood, or that's in some neighborhood where, you scope out that opportunity. But think about what goes into that. All right. You're going to be hiring local contractors to do the work. You're going to be sourcing the materials from local establishments. You're going to be improving a community. So you are building something more positive by the virtue of the fact that you are doing all of this great stuff with the property that you're investing in. So I like to think of it as a way that you can do good for yourself and do good for others. Now, the types of accounts, they come in all the same types of IRAs you would find anywhere else. They're the personal ones, like the traditional, or also known as the rollover, the Roth. They're the employer plans. If you are a self-employed individual and don't have your own retirement plan, like a 401k, talk to us. There might be an option that you can use for your business, which could allow you to put in significantly more than either of the personal IRAs. And then the specialty plans, which are allowed to be used for things like qualified education expenses or qualified health expenses. Now, just to wrap up, I want to talk a little bit about what we have coming up here at Quest. And we have our ongoing live classes that you will continue to see. Self-directed IRA Saturdays like today. Our virtual networking happy hour will continue. We have kind of pulled it back a little bit. It is now just going to be on the 4th week on the Wednesday of the month now. And of course, if you ever miss anything that's out there, don't forget, you can always go to our YouTube channel or our Facebook page and find the archives. We have begun to resume live events again, and they are in the form in the evenings of our self-directed IRA socials. Now, in those events, they're going to be held in Houston, Austin, Dallas, respectively. And again, on the Tuesdays of that week. So Houston the first week, Austin second week, Dallas the third. And again, they've been featuring a lot of great content lately. We've had a lot of great people coming in, doing some education, also offering some network, in addition to a more social setting where there's some food and drink. All right. It always pays to refer a friend over here to Quest. You can get a $25 referral credit for every new account that gets opened here by somebody you refer. And that individual will also get $25 off of the account opening fee, which is regularly $100. Now, what's also nice is sometimes we double that. So keep your eyes out for that. And again, if there's anybody who you know who might be looking to join you with some self-directed investing, please let me know. We also have coming up what we call our Major League Investing contest, if you will. It's going to be a contest where we're going to have a couple of syndicators who are coming in. They're going to tell us about the big deals that they've done, and it's going to be an audience participation in that you as the audience are going to get to vote on who had the best deal. So we've got them, again, coming up at our various offices. So please feel free, register, hope to see you there. It's going to be a lot of fun. Finally, I just want to talk a little bit about the Quest Expo that's coming up. This is going to be in September. We're finally getting to resume it now after the COVID intermission that we had to have. However, this is going to be a very big event. We're really looking forward to it. Not only is it going to feature some keynote speakers, some of the best people in the industry, it also is going to have a great many vendors who are going to be there. These are going to be people that really could be vital to your investing needs. This is a great opportunity to meet people who will be part of your overall team for the investing, but also the maintenance and all the other logistical things that go into managing a property for yourself. So go online, check it out on our events page. And we're in pre-sale now for the tickets, so you can still get them at a bargain. As I wrap up here, this is my contact information directly. If you'd like to have a conversation with me, please use that QR code. It goes straight to my calendar. You can go in, plug it in, find a time that's convenient for you, and I'll give you a call. Just don't forget to include your phone number. Other ways you can reach us, of course, is through our website, questtrust.com. We have a chat box feature. You can also just call us directly through our toll-free number. If you, again, call in, you want to speak to me, my extension is 3554, or you can just shoot me an email. Any way you choose, we're always happy to talk to you and answer any questions you have and see if self-directing is the way for you to go. All right. So with that, do we have our friend Troy who's ready to go?
I'm always ready.
Yes, indeed. All right. Well, Troy, I'm going to turn it over to you and let's get underway.
I'm a little bit limited on my side, making sure I'm up. I want to make sure that the screen is up and going. Can you guys see it okay?
I can see it on my side.
All right, perfect. Well, first off, Steve, thanks again for having me. I know everybody has busy schedules. And again, with everything that's going on in the world today, right now, every defensive position we can all take is incredibly important. And I'll be 58 years old this summer. I have been investing since 1985. I started my career off as a licensed investment broker in Dallas, Texas. I've been specifically focused on the oil and gas industry for going on 37 years. With what's happening today in the marketplace, I believe every investor out there right now has about three big considerations on their mind. First and foremost is rising energy prices, what to do about it, how to take advantage of it, and maybe how to position yourself so that way you can be in alignment with rising energy prices and take advantage of that gain. Secondly is going to be uncertainty when it comes to the tax code. We all know, aware of today, that we are going to be paying much higher taxes because we've created enormous historical debt. And whether it's a Republican or a Democrat in office, there are going to be a lot higher taxes going forward, both between capital gains taxes, probably some limitations on the 1031 tax, and most importantly, the federal income tax. So each and every investor out there, regardless of their net worth, should be looking at using incredibly valuable tools such as self-directed IRAs. Now, I started, believe it or not, my own self-directed IRA back in the early 1990s when I was in my early 20s. I had a great CPA who had advised me an incredibly important tool is how to gain and create wealth by capturing those assets and that growth inside of a legal tax-approved vehicle like a self-directed IRA. So I had IRAs for my wife. I had IRAs for myself. I had my own 401k at my company, but I believed in moving my money from a traditional IRA into a self-directed IRA because I did like having control of my investments, just like Steve said a minute ago. So one of the things about having a self-directed IRA, and by the way, there is a third component that I forgot to get to, which is not only do we have to worry about what's happening in the energy market, not only do we have to worry about the very likely, probably a much higher taxes, we also have to worry about taking defensive positions. What's causing the defensive positions today? And that is, we're now dealing with raging inflation. We're talking about uncertainty in global markets. We're talking about a lot of pressure on fiat currency because of what's happening to the Russian ruble. So there are a lot of elements out of ordinary position today that have occurred over the last 12 months. One of those conditions today is the concern or uncertainty of what's going to happen to the cost of debt and the cost of capital. That's going to affect the stock market. It's going to affect things like real estate. It's going to affect things like exit strategies. And so the defensive position today is about not only putting money into a self-directed IRA with somebody like Quest, who's an incredible custodian that we've used for going on 3 or 4 years, but more importantly, it's somebody who has the education experience that puts on these types of presentations and educational platforms so you can learn not only about what a self-directed IRA is, but most importantly, the types of assets you can pursue, own, and build value inside of that self-directed IRA. I like to think of the IRA, self-directed IRA, it's a safe. Inside that safe are compartments. Everything in that compartment is the things that are most valuable. I go home, I look at my safe. I have gold, I have silver, I have different precious metals, I have collector coins, and I have a whole stack of deeds. The deeds that I have are the deeds to the mineral rights I own in about 7 different states. That is the kind of thing that goes in a safe. So to me, a self-directed IRA, an account that you open with Quest, is like having that safe at your house. So let's get started. Let me tell you a little bit about what we do, what mineral rights are like, and how they might fit your self-directed IRA. I want to stay on cue. First off, every single investment decision you make must be predicated on the reliability and the certainty that the person that's giving you the information has a foundation to stand on. Do they have the expertise and experience? Because there's a lot of people giving out advice today. And in my view, 9 out of 10 people giving advice should not be giving advice. They don't have the experience or the expertise. If your sponsor, your trusted advisor, your product educator hasn't been through a true economic correction, such as 2008, 1997, the dot-com, the 9/11 catastrophe, if they haven't been around 15 plus years, you might really be concerned they've never truly been put to the test of seeing markets that will change direction or correct. On the screen, what you see is I've been doing this since 1985, and I've seen the oil and gas industry go through about 6 or 7 easily definable ups and downs. Now, with each one of those defined changes in the position of the oil and gas industry becomes education, expertise, and experience. So when I talk to you today, I'm giving you almost 4 decades of hands-on, in the ground, on the battlefield examples and experience not only how to avoid the pitfalls, but also how to take advantage when the opportunities present themselves. All right. So today, let's just talk about what is a mineral right. And I know that I've done this presentation 1,000 times, but I'm hopefully going to take the listening audience and make this very easy. In the United States, when land was granted, they were given a right to the parcel of land that was deeded and defined by description of what you owned. We're one of the only countries in the entire world that allow the owner of that real property to actually own the mineral rights of the natural resources below their feet. So when we got land grant days a couple hundred years ago, and you went out and put your stake in the ground and you took that 640-acre tract of land, you were given 3 rights you weren't even aware of. You were given the right to the surface, everything that is on top of the ground, connected to the ground, barns, buildings, any kind of structure. That's one right called a surface right. The other right is an air right. The air right is anything not connected to the land, but directly above your property. And then, of course, comes the mineral right. That's everything that's connected to the description of your land, but only what goes below the surface, okay? It does not include water. It does not include water or like things like gravel or limestone. It mainly focuses on natural resources like water, etc. So the nice thing about it is that in the United States, you have these massive ownerships of property. Now, let's face it, probably 90% of all the surface rights in the United States will have nothing to do with anything as far as precious metals or any kind of natural resource to be developed underneath it. Okay. So what we're talking about are mineral rights that have something of value that would cause us to want to make an investment. Precious metals, coal, oil, and gas. It entitles the owner of that deeded title, that piece of property. It is real property according to the IRS. And so from that standpoint, it's no different than if you own a residential lot or you own a commercial piece of property. My deeds in my safe tell me I own mineral rights in the descriptive area, and I own it in perpetuity forever. It is mine, just like that surface owner says that ranch or that farm is his. Okay. Now, what I believe is that what's below us may be of the greatest value. I know of mineral owners who have found themselves owning mineral rights that effectively thought they had a nice ranch or house or even commercial property. And what they found out is where their position is oil and gas reserves beneath their feet that is stacked like a Dagwood sandwich with layers and layers of oil and gas that's commercially accessible. And those reserves of oil and gas in the ground could be worth tens of millions of dollars in value. And they had no clue. I have acquired mineral rights for as little as $2,000 an acre and found that those mineral rights are worth more like $30,000, $40,000, $50,000 per acre, just looking at the recoverable economic reserves in the ground. So just like the tip of an iceberg, if you don't know what's below you because you're uneducated, that's okay. We have some of the biggest, smartest oil and gas companies in the world that tell us where the oil and gas is being discovered, where it's being exploited, and which mineral rights are the very highest value across the entire United States. So what we want to do is teach you and show you how you can buy these mineral rights by investing directly into the mineral rights, putting them inside your self-directed IRA, letting them cash flow every single month, and not having to worry about those taxes until such time as you withdraw out of your self-directed IRA. All right, so let's just remind you, the natural resources are going to be things like precious metal, oil and gas, and coal. Okay, so now that we have that, let's talk about the key elements of mineral rights. First and foremost, as a mineral owner, you effectively own 100% of all the natural resources in the ground, but you don't have the money to go drill a well or mine for precious metals or recover coal. So what happens is the mineral rights owner become the landlord, and we allow and we initiate a lease agreement between an oil and gas company that believes that drilling underneath your mineral rights is economically viable for that company. Now, we don't have to go hunt them down because that's not how we buy mineral rights at Eckerd. The way we do it is we find mineral rights that are already leased. We know who the lessee is. We know the terms of that lease. We're simply negotiating to buy the terms of future value from current mineral owners who may not be quite as savvy as they should be to understand the current and future value of what will be extracted from underneath the mineral rights they own. So what we want to do is find mineral rights that already have a lease, already have an oil company, already have producing cash flowing wells that have a great deal of upside potential, not only from commodity prices, but more importantly, from the overall extraction potential of the oil and gas that's contained in those mineral rights. So we have zero exposure to losses. We take no risk. We never write a check. I've owned mineral rights for 30 years. I get a check every single month. I never write a check, and I have zero holding costs. I never have to put any money up. I don't pay bills. I don't pay the cost for operating a well. I don't care if they drill 10 wells, 1,000 wells. I don't pay anything. I have zero environmental risk because when I sign that lease or I buy a mineral right that already has a lease, the lease documents clearly state the lessee, which is the oil company, assumes 100% of all liability, all capital costs, all environmental. We are simply sitting back like the king and queen. We get royalty payments every month for a percentage of all oil and gas that's sold. We have zero risk and 100% cash flowing income. It is real property. You own it in perpetuity. It's up to you to decide how much you buy, how much you own, when you sell, or if you decide to leave it in your state or gift it to your children. Okay. Technically, we own all the oil and gas in the ground, as I've said before. We hold it forever. But here's one of the things that I find most of my investors are so excited about: the compounding effect of the value generated by owning cash flowing mineral rights is that we get distributions every single month. Now, inside your self-directed IRA, there's not any tax advantages. I mean, you're going to get your income is not technically taxed at 100%. If I were to invest outside my self-directed IRA, 100% of my income is all 1099, but I only pay taxes on 85%. Since and if you invest in mineral rights inside of your self-directed IRA, you effectively don't have any losses or gains. So you're going to be putting 100% of your income back into your self-directed IRA to allow it to build with a tax deferment by not paying taxes until you withdraw. All right, so let's talk about it. Royalty income, just like the Queen of England today, she receives royalty every single month, every single day for all the property that the king and the queen have amassed. We are 100% passive income generating asset class. There's not another asset class out there that allows you to receive monthly income without any liability exposure, that receives a check every single month, and you absolutely have zero cost and zero liability. It's 100% passive. All right. Now, what are the drivers for oil and gas today? Now, look, things have changed quite dramatically in the last 6 to 36 months. We went from being flooded with oil and gas in 2020 during COVID. We went to a price that went to negative value for a day, meaning that it was below value. You had to pay to get rid of your oil in April of 2020. To now we have $115 a barrel. We're now talking about prices as high as they've been in almost a decade. We're talking about supply shortages all over the world. We have a war taking place in Ukraine. And what we have is a higher consumption rate for oil and gas than we have supply. The supply train has been derailed. So what are the drivers to find the reserves in oil and gas? Well, it's commodity price. If you pay somebody enough money, they will go figure out a way to develop and drill and exploit oil and gas reserves that exist in the United States. If you pay too low a price, there's no financial incentive. No one's going to drill a well. We have technology. The oil and gas industry is the most advanced industry in the world when it comes to utilizing software and hardware to improve the exploration and the exploitation of the oil and gas reserves in this country. We use the same kind of software and the same kind of devices that they send spacecraft to Mars or to the moon or anywhere else. So we use triangulation to guide drill bits 2 to 4 miles in the ground within inches of accuracy because we use satellites to help guide our drilling bit. We didn't have that 10 years ago. We had geologists and geophysicists using all their intellectual assets to try to guess at the right place to drill in the right formation. Today, we have an industry that's essentially, when you drill horizontal wells in shale formations, which is what's created so much value for this industry, we're looking at about a 98 to 99% success rate during exploration and drilling. Usually it's a mechanical failure that causes you to have a well that's not commercial. So when I think about being a mineral owner, I'm thinking I've got the most advanced technology. I have rising commodity prices. We have these incredible shale basins, I'm going to show you in a second, that are loaded with oil and gas, some of the highest reserves on the planet, and it's all sitting underneath our feet. Now we have a market. The market opportunity is private investors like you and me can now physically buy mineral rights under big producing wells with Exxon or Marathon or Chevron or major billion-dollar companies. And guess what? The market economics are so favorable today because of this evolving market. We now are looking at close to a $500 billion opportunity to buy mineral rights directly as private investors and do it inside of our self-directed IRA. Now, this is a map that has been evolving over the last 15 years. Everything you see in light pink and mid-range pink are brand new oil and gas reserves that have been discovered because of technology in the last 15 years. They didn't exist 15, 20 years ago. We knew these hard shale formations like wet concrete existed 1 to 2 miles below the ground. We simply didn't have the mechanical expertise, the software expertise. We didn't have the engineering expertise at the time to extract oil and gas from these really hard, wet shale formations loaded with oil and gas. We couldn't do it. We couldn't figure it out. Well, the mother of ingenuity is great whenever something happens. What happened is we ran out of oil and gas virtually in 2008, and the oil and gas prices rose to a record high of $145 a barrel. The oil and gas companies then were able to take the risk, apply the technology to figure out how to solve the riddle to the puzzle, and we did it. And we did it because we figured that these buried basins, these huge buried basins, were loaded with oil and gas, and we figured out how to get that wet concrete-like shale to open up and now give us record-setting production for the United States. And we can well be on our way to energy independence. We don't need Russian oil, Saudi oil, or OPEC oil. Guess what? Everything you see in pink on that map in front of you are mineral rights that we can buy. The question is, which mineral right? How do you figure that out? I'm going to show you. So what we have, each one of these pink items on this map, defined basins, are essentially buried Grand Canyons. You can see in this picture the white line that goes across in the sunset, and each one of these layers can be a depositional event that occurred over time. It could be 50 million years ago it was deposited. It could be 100 million years ago it was deposited. But the conceptual idea is that through tectonic movement and through the gathering of dead plants and animals, organic material, all that organic material was trapped and covered over time. This Grand Canyon was filled up. When it became like a pot of boiling rice. It percolated. The heat from the core of the earth, the magnet that's inside the center of the earth, cooked all those dead plants and animals. And over time, because they were trapped in non-porous reservoirs, they cooked and converted themselves to hydrocarbons. So we've known where these canyons were at. We know how big they are. We know how massive they are in size. But these are some of the largest oil and gas containments anywhere on the planet. They're just trapped in really hard rock. We figured out how to get it out. Here's how we did it. We take a well. As you see in the right-hand picture, we go drill a well. We go straight down 1 to 2 miles. And then we let the drill pipe turn sideways with just under a 90-degree angle. By doing that, it allows us to go out horizontally 1 to 2 miles. Now, why is that important? If I'm a mineral owner, everything I see in the schematic on my screen, which shows the underground plumbing, if I'm anywhere inside of that white box, I have a direct right to any and all oil and gas that is being pulled out of the ground from everything inside that particular schematic. So the nice thing about being a mineral owner is you don't have to win the lottery ticket. You don't have to guess the right acre of land. What you invest in is fractional mineral ownership, allowing you to own a piece of a significant oil and gas extraction opportunity like you see on the screen, and you get your fair share, your percentage of all the oil and gas value extracted from underneath the ground. Let me take a drink real quick. All right, now I'm giving you a screen that shows you what it looks like. In its raw nature, you have a pad site that covers maybe 4 to 5 acres. You'll have 4 or 5 wells drilling. They go straight down vertically and out sideways 1 to 2 miles. Very, very minimal impact to the environment. Very minimal. Everything occurs 1 to 2 miles below the ground. We then inject sand and water. And all we're doing is doing a jackhammer. We're cracking the formation 1 to 2 miles below the ground, completely isolated by pipe, completely environmentally safe. And these oil companies have now perfected the ability to frack or break open that really wet concrete-like formation. And it results in not only oil and gas flowing in record-setting quantities, but allows us to know that we have essentially had the opportunity to have multiple wells drilled in the same formation, in the same pad site, underneath the minerals that you and I have acquired for our self-directed IRA. So what you end up with is that nice picture in the middle, down at the bottom, in those nice big green envelopes. And that is, I get a check every single month for every well drilled in my minerals, with every single value of royalty income coming to me for every oil and gas drop that is sold, for every natural gas molecule that is sold. We get our share of 100% of the production. Now, who are our tenants? Now, this is really important. When you rent commercial property or rent house or your multifamily property or your self-storage, you're wondering, well, who's my tenant? Are they going to pay the bill? Well, let me tell you, as a mineral owner, who our tenants are. Major billion-dollar companies like Exxon and Marathon and Derby and Continental and Camino and Cimarex and EOG. These are the absolute largest, financially most solvent companies in the world who are our tenants, drilling oil and gas wells at $10 million a piece for free on our property and giving us checks every single month. I know I'm going to get my check. I know the check's going to clear. They're not going to miss a payment. And I now have mineral rights with producing wells that can last 25 to 50 years. Passive with zero cost and zero exposure. I want to keep beating that drum because I want you to understand it's a perfect investment inside your self-directed IRA. So let's recap it. Monthly cash flow into my IRA every single month. It allows me to compound. It allows me to grow that portfolio inside of my self-directed IRA because I get such frequent cash flow. 12 distributions a year and 1 tax statement. How easy is that for us to manage? I can be on the Cayman beaches and not worry that I've got producing wells making me money. It's tax deferred or tax-free income that goes into my self-directed IRA, and it's assets that I can easily pass to my beneficiaries outside of probate, because the reality is I don't mind giving my grandkids mineral rights because there's nothing they ever have to decide. The oil companies handle it all. There's nothing they have to ever pay. There's no cost. There's no capital exposure. They simply have to figure out how not to hurt themselves endorsing the back of a check and putting it in their bank account. It's a great investment. It's 100% passive. It's all cash flow, and we take zero risk. I think you need to think about how this might look inside your self-directed IRA. Now, I like the fact I like money coming in, and I don't want any money going out as a net income asset. As we get older, we need less moving parts. We need less holdback, or what I call safety accounts, worrying about, will that rent house rent? Will there be any kind of rent forbearance? Is the liquidation component of trying to get out of one of my properties going to cost me commission and fixing the house up, or any kind of drain of my capital? You do not have that same kind of exposure or concern when you invest in mineral rights, because it's virtually 100% in of income and zero outbound as far as any kind of exposure. Now, at Eckerd, we have a little small strategy that we've been using for just under a decade. We believe that the value in doing what we do is we like the aggregation, maturation, and liquidation. We want to do the AML strategy. We as a company like to aggregate tens of thousands of mineral acres and put them into portfolios that allow you, as either a self-directed IRA holder looking to invest inside of your self-directed IRA or your traditional account, we want that opportunity to bring to you all the sweat and experience and labor that we do to aggregate minerals across oil and gas basins that we believe are the premium areas in which to buy mineral rights. We believe in maturation, and the maturation is simple. We want to buy an asset for $1, allow additional entitlement like wells drilled and production coming online, and it matures that asset kind of like an orange grove. We're going to plant the trees, but we won't have commercial orange harvesting for probably 3 to 5 years. But when we do, the amount or the abundance of that harvest is going to be something that allows us to create a strong financial recovery and a strong financial return. The maturation for us is we'll buy a mineral today. Those billion-dollar oil companies will develop wells on our property. The cash flow will increase, and we end up seeing our assets maturing right before our eyes in terms of cash flow and proven reserves in the ground. We also have a liquidation component. We always know there is the chance or the probability we might choose to liquidate some of our minerals because the value will be in the cash flow. It will also be in terms of what the reserves in the ground are worth. Let's talk about where we're at today. Today, I'm asking you a question. How would you like to have an asset inside of your self-directed IRA that is the equivalent of 700 employees producing income for you 24 hours a day, 7 days a week, 365 days a year? Eckerd Enterprises, Eckerd Land and Acquisition, our company, we have accumulated minerals that today have 700 oil and gas wells in the state of Oklahoma. They produce every day, 24 hours a day. We are generating profitable income, and we never have to make a single decision. We have zero risk and zero liability. So if you can think about having a portfolio that you systematically invest in, $25,000, $50,000, $100,000 a time, you do it inside of your self-directed IRA, that income gets trapped back inside your IRA, just letting it compound and build. That is the kind of asset that we all seek and want to have. Now let's talk about where we're at today. Today, we're looking at oil at $115 a barrel. It is up literally $30 to $40 a barrel since December. We're at a very, very difficult time right now. Because of the events of the last 2 years, the capital has been withdrawn from the oil and gas sector, meaning that the federal regulations have been put in by the Biden administration. The policies and procedures have been put in place involving drilling and pipelines and transportation and refining. The desire to have green energy, the desire to have GSC be followed, has all put an instrument in place that has been absolutely a catalyst for rising oil prices long before Russia decided to attack Ukraine. And that was the oil companies have been told, we're not going to lend you any more money. We're not going to give you more capital. You're going to have to learn to live on your cash flow. But all the while, as a country, we have come out of COVID lockdown. We now are at higher demand for oil and gas than we were before COVID. So I don't know about anybody else listening, but Economics 101 is pretty simple. Rising demand, shrinking supply means rising prices, because the fact is people will pay more for the limited supply. Now we add in what's happened in the last 2 weeks. Now we have a major oil supplier, Russia, 4 to 7 million barrels a day with sanctions. We have cargo ships that are being captured and seized. We're having buyers of Russia's oil being told they can't pay Russia for their oil. We have Russia, who's too busy fighting a war and is watching all the major oil companies have pulled out of their country as far as oil and gas partners and all these different exploration projects inside of Russia. They've all pulled out in the last week. What do we have? We have a situation where the global supply side of oil and gas is going to be short 4 to 10 million barrels a day from oil and gas. And that's if this thing doesn't escalate further. We already had a problem in the United States in that we used to produce 13 million barrels a day. That dropped to about 11 million barrels a day and even lower during the COVID lockdown. We're still sitting 15 to 20% below the supply of oil in this country we had back in March of 2020. So now here we have it. We have everybody's back up to full demand, 20 to 21 million barrels a day. We're only cranking out 11 million barrels a day, which means we're buying 9 million barrels abroad. And now we have a disruption in global supply. The reason you're seeing gas prices higher, the reason why you're seeing oil prices higher, and the reason you're seeing inflation going to be absolute raging the next 3 to 5 years, there is no solution to supply anytime in the foreseeable future. So what I see for mineral rights owner is that if you have the desire and you qualify and you have money that you could put into a IRA and open an account with Quest, one thing I'll tell you is if you open an account with Quest between now and the end of this year, Eckerd Land and Acquisition, if you become an investor with us inside of your self-directed IRA, we'll pay up to $500 of your opening account with Quest. We'll cover that cost. We know that once you understand investing in mineral rights, you will become a mineral rights owner forever because it is the easiest, most understandable investment asset class you can find. Now, I like to think about what I'm going to own and how I'm going to live the rest of my life. I'll be 58 this summer. I want to sit on a beach. I want to watch the waves. I want to count the sand granules. And I want to know that I've got literally hundreds, if not thousands of wells in 5 or 6 states producing income for me 24/7, where 100% of the American population uses, consumes, or participates in the consumption of a barrel of oil every day. The computer you're on, the carpet you stand on, the clothes you wear, the medicines you take, 100% of everything you touch in a single day is made from, transported by, a byproduct of, or has containment of a barrel of fossil fuel, oil and gas involved in it. That's the kind of asset I want to own, where I have 100% consumption across every single consumer inside the United States. How do I get started? Very simple. You just call the 800 number shown on your screen. You can email me at t.eckerd@eckerdenterprises.com. We have 2 wealth managers on our team. They are not commissioned. They are there to help you to understand what you do. Now, we prefer in our situation to use a really, really professional, top quality custodian like Quest. We've got a great relationship with Quest. We do have other custodians that we have that literally come to us because someone's already opened an account. We find a lot of our clients will change and end up going to Quest as their custodian because of their fantastic service. I have an account with Quest. Their follow-up and customer service is off the chart. What we want you to think about today is the following. Inflation's not slowing down anytime soon. The only way to pay off $7 trillion in debt, you have to inflate the dollar. We're stuck in this for 3 to 5 years minimum. Telling you, trust me on this. We're not going to see oil prices come down for 3 to 5 years because we have a complete derailment of the supply side. We know it's coming, whether you like it or not, massive tax increases. So today is your chance to take action, contact your Quest representative, open up that self-directed IRA account. If you have it at another custodian, you might want to move it to Quest. Quest gets what you're going through. They get you want to make your life easy. They understand that mineral rights are a self-directed qualified asset class, and they're very, very good about helping you get what you need to facilitate the transaction. That's all I've got. I'll turn it back over to you, Steve.
Can everybody hear me?
We can now. Yes, sir.
Awesome. Okay. Well, thanks for all that information, Troy. That was tremendous, as always. We do have a couple of questions that are in the chat box,
Okay.
so I'd like to hit you with them. The first question, it comes from George Lycan, is, does the price of a lease track back to the price of oil and gas?
So the question is, I'll regurgitate, does the cost of a lease, which we don't lease anything, but if the cost of a lease ties back to oil and gas, the answer is it all ties back to the price. So if oil is at $25 a barrel, there's not many oil and gas companies that are going to go out and want to drill a well because it's sub-economic. So if you wanted to lease your minerals, you might actually have to either give it to them or take an incredibly low price for your lease, because you're going to have to find some way to encourage that oil company to justify drilling at low commodity prices. Today's a different story. At $115 a barrel, you're going to start seeing brand new investment capital come into the market who are going to be outbidding each other to try to get the rights to develop your minerals by paying you a much higher lease payment. But let's take it to what it really does, Steve. Maybe the question should be more about, does the cost or the investment capital required to buy a mineral right today, is that higher or lower because oil prices are rising? The answer is yes. What we could invest in a year ago might have been an average of $10,000 to $12,000 per acre. So far this year, we've been able to maintain that value somewhere between $11,000 and $14,000 per acre. I can assure everyone listening, though, new money coming into the market who does not know what they're doing will end up outbidding each other to try to get into the oil and gas sector because they all want to own oil and gas directly. It's my belief that because of commodity prices being higher, we're going to see a dramatic increase in competition and ultimately the price of the investment capital required to buy mineral acres. Hope that answered it.
Yeah, I think that was pretty complete. I think that definitely got at the heart of the matter there. Next question. Is it true that it can, and we emphasize the word can in this question, be 100% tax-free on an investment in the exploration side?
Yeah, so this is off topic. When you drill an oil and gas well, under President Trump, who believed that helping the energy industry by creating capital incentives, he allowed the acceleration of tax write-offs for investors. So starting when the 2017 tax law was put in place up through this year, 2022, if you write a $100,000 check, not in your self-directed IRA, obviously, but you write a check as an investor, 100% of that investment is written off this year. But I'm going to remind everybody, the highest level of crooked, illegal behavior in oil and gas occurs in the participation in drilling a well. I will also remind the audience, Steve, is that if I invest $100,000 in a well that is successful, or I write a $100,000 check in a well that turns out to be a dry hole or uneconomic, I still get the same tax benefits. So most investors must remember it has a big tax incentive, 100% tax write-off this year, 2022, but the goal is to make money. So if you can't make money and you're going to lose because it's a bad well or a crook or a Ponzi scheme, you don't really effectively get the tax write-off. What you get is a disaster, 100% loss of your capital. So to me, this year is the last year of that accelerated 100%. Next year, I think it goes down to 90 or 80%. So this is the last year of a big write-off, but don't get enamored with tax write-offs in oil and gas drilling. Your job and your goal is to make a profit, but you want to play with 63-cent dollars because you're playing with after-tax assets.
Okay. All right. Next question we have is, how do you account for replacing deleting wells?
I think he means depleting.
Oh, depleting.
Yeah. So let's face it. One of the best parts about oil and gas is that it's one of the only natural resources on the planet that disappears forever. So you have water, you drink it, you go to the bathroom, water's still here. Liquid never just disappears, right? Same thing with gold, silver, precious metals. Coal and oil and gas are fossil fuels that when burned, dissipate and they're gone forever, right? So you're going to have a well that comes online. It starts to deplete because the oil and gas you extract from it is taken from a finite quantity. The reality of it is, though, without going into too much detail today, is the successful way to buy mineral rights is you're buying mineral rights that you believe have one of three components. Early staged wells that have just been recently put into production that have a long economic life going forward. But more importantly, that particular mineral right you buy has multiple additional wells that will be drilled that you really haven't paid market value because they haven't been drilled. In other words, it's unentitled at the time of acquisition. And last but not least, for me, I want to buy mineral rights in areas that have more than one formation. So I could buy mineral rights today with 2 wells producing from a zone at 8,000 feet, but I know that there are formations and reservoirs at different sub-depth levels that can end up generating another 5, 10, 20 wells. So it's a complex question they've asked, but the answer is depletion occurs, but you have to understand the mineral market like Eckert does to understand how to buy the minerals, understand that drainage every day, and knowing what the upside is by additional development or entitlements.
Great. All right. Next question has to do with where some of your sites are. Specifically, the question asks about the Permian Basin.
Yeah, I'm not a Permian Basin fan. We have acquired in the past, and we have looked at a complete evaluation of the Permian Basin. I liken the Permian Basin to buying at Neiman Marcus versus buying, let's say, at Walmart. Our company focuses on Oklahoma, North Dakota, and a couple other basins. We have made offers in the Permian Basin, but it's very difficult for me to justify the economics. And the reason being is everyone believes the Permian Basin is the Saudi Arabia, the United States. And that's great. But I'm a math guy. I'm an economics guy. And the way I look at it is as follows. Every mineral acre I acquire is like a straw. So if I buy 1 acre in the Permian Basin, it is only accessing a straw to the reserves below that acre. Same thing in Oklahoma. The difference is the Permian Basin straw is going to cost me between $45,000 to $150,000 per mineral acre. My price or my investment asset base in Oklahoma is somewhere between $7,000 an acre up to about $18,000 per acre. Now, the reason it's important is you might have a Permian Basin mineral acre that has 10 formations in it, could end up holding 36 wells. Oklahoma might have 5 formations, hold up to 20 wells. And so you might perceive that there's greater well count and greater reserves, but when are you going to see those reserves? Your lifetime, your kid, your grandkid, your great-grandkid's lifetime? I'm about value, and the value to me is, why don't I just invest in Oklahoma at $12,000 per acre and buy 4 to 10 acres, 10 straws, 4 straws for every straw in the Permian Basin? So, Steve, without trying to bore the audience, it's simple. Permian Basin is a fantastic oil and gas reservoir, probably the best we have in the country. But if I can buy 5 acres in Oklahoma versus 1 Permian, I can guarantee you the economics are in my favor, and I make more money, more reserves, and book more cash flow. So it's all about buying in the right. Remember, you make your money on the buy side on any investment.
Right. And actually, maybe to touch on that a little bit, someone was wondering if you had discussed ROI as part of the process itself.
Well,
sounds like you were beginning to touch on that a little bit with that conversation.
Well, what we try to avoid on any of these presentations is talking about specifics because this is more educational in nature. But I can just share with the audience that we started buying mineral rights under our current directive in 2018. We started off buying minerals in Oklahoma using my own money. We brought on private investors both in and outside of self-directed IRAs. We now have accumulated just under 11,000 net producing mineral acres. We have 700 wells. We have roughly 370 sections of land, which is almost about 300,000 mineral acres of reserves that we have producing. 64 individual portfolios to date. We're averaging 17.8% cash on cash, averaging across all 64 portfolios. By the end of this year, because of commodity prices, because we bought the right minerals, I'm going to guess our cash on cash across all 64 portfolios will be over 25% per portfolio cash on cash. Now, today, we're accumulating minerals in a little bit larger tranches because from our standpoint, Steve, and for whoever asked the question, it's our belief that minerals are going to be very competitive going into the last half of this year. So we have locked in roughly $150 million of minerals that we're acquiring, and our base value in our financial model was when we started putting these minerals under contract about 60 days ago was $70 a barrel. We're at 115 today. So everything we believe we bought in January is almost half off of what you would be paying sometime, let's say in March or April this year. In other words, it is very much driven by commodity prices, market perception, and of course, what you can acquire at the time.
Okay. Somebody had a question too about a specific area. It looks like are leases available in Eagle Ford area of South Texas? Anything
Again,
out there?
Again, that's a good question. The person asking the question is asking about leases. We don't care about leases. We want to buy minerals. We want to be the landlord. You can buy minerals in any basin that you want. We've completely evaluated the Eagle Ford Shale, which is in South Texas. We evaluated that over 2 years ago. The problem is it is a very finite market. There's like what I call a bullseye. And the bullseye is where the ConocoPhillips and the Exxon have already gone in and leased, and they've been drilling. There are very sophisticated, savvy owners that own those minerals down in the Eagle Ford Shale. The problem I have with the Eagle Ford Shale is in those areas, they charge you a property tax for the value of your oil and gas reserves and for the amount of the cost of wells that were drilled. I have two uncles that my wife's uncles both own minerals in the Eagle Ford Shale. When their property was leased and they started receiving their multi-million-dollar checks, they also received a huge tax bill from the taxing authority in the counties they were in, saying that there was $80 million worth of wells drilled in your property. So now your property's worth $80 million. Here's your property tax bill. I don't have property taxes in the state of Oklahoma. So in the case of 2 years ago, there were many mineral owners down in the Eagle Ford who were trying to sell their minerals just to pay their tax bill, because failure to pay your tax bill meant foreclosure or loss of your minerals. So each state has its own rules and regulations. Each basin has its own nuances. You go up to the Utica in Ohio, there's only one zone. So once you start depleting that well, you have a de minimis value in your minerals because there is no other reservoir for future development. So when somebody says, what's the lease? They really mean, what's the mineral rights going for? And I think the mineral rights going down in the Eagle Ford, we're starting at somewhere in the neighborhood of $35,000 up to $70,000 per net mineral acre. And I want to say that was like 12 months ago. We've evaluated 7 basins completely thoroughly with our geologists, our land team, our engineers. We know exactly where the values are. And if somebody said, Troy, where are you buying? I have no reason to leave the state of Oklahoma anytime soon, because I believe we have $250 million worth of grade A, class A, tier 1 minerals still to be acquired. And in fact, that's growing because the new exploration results, Steve, the biggest horizontal well in Oklahoma's history was just drilled and put online about 90 days ago. We have 7 of our portfolios in that package. This well produced 90,000 barrels of oil in 30 days. Unbelievable. So we're not going to leave a fishing hole where we're catching fish so fast that meet our criteria. Our boat's full of fish and the fish haven't stopped biting. We'll stick in Oklahoma.
Good to know. All right. So I guess let's touch on that, because we have a question about, is there a risk in setting up a portfolio now with oil prices on the increase so sharply? Well,
so here's the answer. Every market has its tip, and I'm going to be candid with everybody listening. I think the real estate market was overblown about 6 months ago. I think the cost of rising inflation and the cost of capital going up, there's probably 9 out of 10 real estate deals that have been done in the last 7 months and probably going on today. I hear people still buying into apartment complex and self-storage. They're all predicated on one thing: exit strategies, because of low cost of financing, low cost of capital, and a higher demand. It's kind of the greater fool theory. Everybody buying somebody else's property and thinking they can increase occupancy. Oil and gas is a little different. We have something going on today that really is quite unusual. One, we've never been able to buy mineral rights that have so many duplicate, repeatable number of wells being drilled in a single mineral section. I buy a mineral with 2 or 3 acres, all of a sudden it has 4, 6, 8, 10 more wells, right? What's driving that is that the higher the price of oil goes, the more economical it is to drill the well and recover the oil and gas. Wells drilled 6 months ago were running at $55 oil. So if I spent $10 million, I had to make 225,000 barrels of oil to break even. At $115 oil, I only need to have 75,000 barrels produced to pay out my cost of drilling that well. I'm going to drill 5 more wells because today it's so much cheaper. So what that means is, to answer the person asking the question, is the following. What we see in the last 3 years has been unbelievably going out of business prices for minerals. We've been buying 40, 60% below market. I don't suspect we're going to see the market really start to get, I would call, unreasonable or uneconomic until probably the middle part of next year, when we're running $150 a barrel. We have acquired to date minerals that are still based on what we were paying last year, because we're the only cash buyer in the Anadarko Basin. We're spending about $10 million a month as a company. But I think and I believe what you're going to see is a price point sometime in the next 18 months, probably closer to 12 to 18 months out, where I'm going to have to tap the brakes and say, do I want to pay $25,000 or $30,000 an acre even if oil's $150. Why? I never like to walk out to the edge of a cliff without a safety rope. If I'm paying $150 to $200 commodity price value for minerals, what's my exit? What's my value? I have a greater chance of falling than I do of standing up. So at that point, I'm going to probably tap brakes, maybe not buy minerals, or at least find them in different areas that may be more economically viable at that time. Today, we got a wide open window for the next 12 months, specifically for us as Eckerd in the Anadarko Basin in Oklahoma. We're the #1 deed filer and the #1 mineral buyer last year in 2021 and 2022. With acquisitions we have, we will probably be 2 to 4 times larger than anybody else buying minerals. That gives us a vacuum of mineral opportunities that nobody else sees.
Great, great. Now, I know we're bumping up against the top of the hour, so I want to be respectful of everyone's time. I know we did started a little late, but I do want to just ask you this one last question here. There are still a couple of other questions that we didn't get to, so are they okay to kind of reach out to you and follow up too?
Yeah, you can email me. You can always call my cell phone, 469-422-1781. Again, 469-422-1781. I answer text all weekend long. I've got 600 high net worth clients that are just smiling from ear to ear with all the money they're making. But you can text me, let me know what's going on. I'll be glad to respond to you. Today's my granddaughter's birthday, so I'm going to spend a little time with her. But text me and I'll get back to you ASAP. I pretty much work 24/7. What's the last question you had, Steve?
The last question, which I'd like to ask, is how long must you stay invested in the program?
There's no program. You're buying actual mineral rights. So there's no partnership. There's no LLC. There's no management agreement. There's no ongoing fees. There's no back end. There's no reversion. We distribute checks every month. We don't charge any fees. So the question is, how long to be in it? Mineral rights last forever. So the real question is, what I showed in my AML is the liquidation component. For me, I like to look at possibly liquidating some of the minerals after about 48 to 60 months of holding. Why is that? Well, like an orange grove, when I get that grove planted, it takes 3 years to start getting commercial production. About the 7th to 10th year, I'm probably peaking at the highest production from those navel orange trees, right? In oil and gas, at today's value, we're buying mineral rights. We expect to have really significant increases in wells drilled and cash flow and productivity, which maximizes our value between now and the next 48 months. There's a good probability I'm going to want to sell 25% of my portfolio when oil prices are super frothy. Investors are looking for a yield higher than inflation. And I don't mind selling my mineral rights I buy today for $1 for $3 to $5 in 24 to, well, basically 48 months. Now, the reason that makes sense is our cash flow over the next 36 to 48 months should get us paid out. Why not go sell it for 2 to 4 times the money? Part of our portfolio, we take 100% of our capital off the table. We end up owning 2/3 to 75% of our minerals free and clear, and we go do it again and again and again, just compounding that portfolio inside of that self-directed IRA we set up with our good friends over at Quest.
Okay. All right. Well, I think that's a great place to end. Troy, I want to thank you for taking your time on a Saturday. Doesn't sound like it's really anything new to you, though. I love what I do.
I love what I do. I live, sleep, and eat and breathe this. So I'm always good.
Good. Well, it's been a pleasure having you again. I hope to see you again soon at an event sometime here in Austin. Anyway, we'll wrap it up then. Yeah. If anybody missed some of the information on here or wants to review it, it will, of course, be here on our archives immediately after we're done. And with that, I'm going to close it out. And again, thank you, Troy, and thank all of you for participating today. And we'll see you next time. Thank you.
Take care, everyone. Take care.
Goodbye.